sort of kick off by making sort of quick introductions to the panel. We won't go into everybody's sort of past histories. On my sort of far left is Alex. Alex is from Moscow. He is head of blockchain practice at the Moscow Exchange Group. To Alex's right is DC. DC is part of the HashKey Digital Asset Group based in Shanghai and Hong Kong.
Yeah.
Right. And active blockchain investors focused on the institutional side and high net worth investors.
Correct.
Right. And to my immediate left is Jack Liu. Jack Liu runs Circle in Asia and serves a large portion of the retail markets as well. Right. Well, thanks for joining us today. I thought I'll kick off by asking our panelists to just give us a little bit of sort of pull back and give us what they've seen as sort of recent developments over the past year with respect to infrastructure, institutional maturity, and the management of risk in these, I would say, new financial firms and new financial markets. So maybe to open it up to Jack, you, DC, and Alex to say, hey, give us a sense of the things that have either surprised you or the things that sort of are noteworthy over the past year that have sort of progressed and developed. Yeah.
Okay. Actually, we have a lot of activities and initiatives in decentralized world. But anyway, we don't see as one of stock exchanges any kind of instrument that can be bought by institutional trader at the moment. That's amazing situation. More than 1,000 of startups with tokenization of everything and no instruments. That's one of thoughts and that's one of big problems that we need to solve. Another one is about taxations for this kind of instruments. It's also impossible to pay taxation. That's it.
Yeah, so thousands of tokenized projects, but nothing to buy.
Yeah.
DC?
For me, I'm from an institutional background. For the past year and until now, we've seen a huge inflow of institutional money coming into the crypto space. Together with the institutional money, we're also seeing an influx of talents with traditional finance background, either in trading or asset management.
So some serious influx of talent attracted by the innovation, attracted by the money?
By the market.
By the markets. Jack?
Yeah, I mean, if you ask me what's been most surprising, I think, by the way, my background, I started my career in Barclays as well, surprisingly, and then obviously worked a number of companies in the space in China and then abroad. It's that this disconnect between what's going on in the Asia markets and what's going on in the, let's say, US or European markets has extended for so long. Like, you have not had a convergence of philosophy to date. I think people are still very much in the US having a conversation around when will institutional money drive us higher. And I think that conversation's been going on for 5 years now. And the asset class has gone a lot higher. You can always fingerprint and say, okay, well, it's still a drop in the bucket, et cetera. But what is curious to me is that it seems that the companies that are focusing more on servicing the retail, the long tail market, has done very, very well. So, you know, prime example is if you built a private ledger hoping for moving existing assets onto the blockchain technology, you may have raised a lot of money, but you haven't gotten a lot of traction.
Not done jack.
Yeah, and you can always say that, you know, we're missing this solution and this regulatory clarity, but the reality is that while everyone was focusing on working on a Bitcoin ETF, you had something like Ethereum come up that focused on letting anyone potentially create a token. And so yeah, there's a lot of focus on whether it's a security token or utility token, but it seems to me that like the awakening has to be that this technology is very disruptive. It's up to the institutions to figure out a way how they can accelerate. And the smart ones have done that by sort of separating the way they do things into maybe carving out a spin-off fund to more keep up with the space. And I think hopefully that clarity will come sooner than later.
So the sheer dichotomy between, I think the sort of big point, sheer dichotomy between the Asian markets and the traditionally more developed asset class markets, right?
Yeah.
And so interesting, sort of a point of view from a regulator coming out of Moscow, point of view of an institutional play coming out of China, and then obviously, Jack, both with your background from Barclays, and then obviously working retail in China. Alex, sort of turning to you as part of the Moscow Stock Exchange, you're sort of a fully integrated play. You're a settlement house, you're a depository, you're also on the Hyperledger architecture group. You advise folks on regulations, you're helping them build the infrastructure. You're the one who's practically getting things done in that part of the market. Share with us some of the initiatives that you guys are working on to regulate and or try to regulate crypto and tokens. What are the kinds of new services that seem to be emerging? What are some of the big ahas that you're seeing?
Actually, we have started our investigations like 3 years ago with our blockchain lab. And first project was to do decentralized, transparent e-voting system for annual general meetings. We implemented beautiful technology using zero-knowledge proofs, non-interactive, and all other words that are modern ones. But finally, they find out that there is no demand on market for transparent voting. So there is no one who wants to pay for it at the moment. Then we switched to tokenization of normal assets. Like we already launched to market several commercial bonds tokenized through Hyperledger Fabric. It is working. It has some pros and cons to run this kind of papers as a set of smart contracts. But anyway, it is working. It is experience. And now we are trying to focus on ecosystem for any kind of tokenized assets to make a kind of a global distributed ledger where one can receive statement of holdings that he really has this tokenized asset, and this tokenized asset doesn't depend on any kind of smart contract. So you don't need any kind of lawyer knowing Python to investigate it. You just receive normal Swift form statement of holdings. And another insight from our experience is that it is completely different economical model. If someone comes with something like, I want to tokenize this, in 95% it doesn't make sense. Blockchain looking like Jennifer Lopez combined with aloe vera, it is beautiful. It can be light somewhere, but it cannot be useful for commercial usage. It is beautiful, it helps, but no one knows what for. And only 1% of all use cases is true ones. But there is a lot of another use cases to crowd financing, to crowd running that were impossible before. And our task is to make it real, to help this new industry growing.
No, I think it's great to see some candidness coming from a regulator as to what really the frustrations are, who pays for the infrastructure, quote unquote, that we're trying to build, and is there truly value getting added at a broad scale, right? Jack, you've been Chief Strategy Officer at OK, a digital asset exchange. You now lead Circle Asia. You spend a lot of time on the product side. You know, from an infrastructure side, can we fit crypto into a legacy box?
Yeah, I think you can, but that's not really where the adoption's gonna be. I think, you know, it's been 10 years since Satoshi's white paper came out, and even weekly I have new realizations of how profound innovation it is. So if you think about taking a step back, I think people are still trying to build, you know, very centralized companies, very much taking a piece of economic rent-seeking behavior. But if you look at the edges of this space, you're seeing a tremendous trend towards basically business models that look more and more like 0% pre-mine, all incentivized to the users. So if you look at the exchange infrastructure, you're seeing the trend go from obviously fiat exchanges, which were all the rave, and back in the day, you would never think about doing a crypto exchange because you would have a large trading against the U.S. dollar and against the Chinese RMB, and people thought, you know, the market was over once that was shut down. But now, if you run a crypto exchange, and Circle acquired one in Poloniex, it's much larger, and you've seen pure play crypto companies from a results perspective do much better than, you know, hypothetically, if Bitcoin were to be adopted by sort of traditional institutions which manage trillions of dollars, then hypothetically there's a lot of money to be made. And so really now, even while this back to my point earlier, this disconnect. While this conversation is still going on, there are now exchanges in Asia which say, I'm not just going to do an ICO. I'm going to make sure my ICO only is allocated to people who are trading on the exchange. So this is the recent hot, like, trading is mining thing. I'm not sure how much is getting covered here in the US, but essentially it's saying that if you come trade on the exchange, whatever fees you pay is essentially you're buying a stake in the exchange. So the long-term view of that is that the traders will own the exchange. And there are going to be more and more extreme examples down this path towards an endpoint potentially where it looks just like Bitcoin, where the miners get allocated all the coins, not the founders or the developers. The founders and developers of Bitcoin actually get selected by miners or to get donations to keep working on the core protocol. And you could see exchanges or other Web 2.0 companies run this way. So we went from a conversation of letting the long tail invest in these products. So yes, that's great. We don't have to be valley firms in order to get access to the next Uber or the next Airbnb, but it's more profound than that. Now you're going to have a world where the investor class, and to some extent the founder class of these kind of generic marketplaces where users are contributing a lot of value, those are going to get tokenized, and those are going to get owned by the actual actors in the network which are contributing value.
So if you have these, let's say if you have these environments where you have the infrastructure is built on this notion of a long tail of a large number of investors playing small points, where in that sensibility do we look at it and say, how do we manage risk? How do we manage the bad actor problems? How do we, what role do regulators play in that setting, in such a distributed setting? How, and back to Alex's point, are regulators competing with each other now?
I think so. I think regulators, there's on the one hand, they care about users, of course, but they also, there's a bit of how much of the legacy system do you currently have, and how much is this an opportunity for you? So jurisdictions that are smaller may look at it as a great opportunity. And so we would never have thought, Malta is even in the conversation as a jurisdiction as a financial powerhouse. But when you have a very mobilized company set up, or if you want to call it company, or these networks, they can be registered in Malta or Singapore or Gibraltar. So in that sense, then the traditional regulators have to look at best practices. So the user can't just count on regulators. And the good thing is they don't need to count on regulators for that protection. One, there's a push by market forces for more transparency. Secondly, there's not as much concentration risk. So now, for example, assets are not sitting on one exchange, they're sitting on hundreds of exchanges. And so the amount that's sitting on any one exchange may not be as great as it was back in the Mt. Gox days. And users do have an exit option, right? They have an ability to click on the withdrawal button or something like that. So, and then we're going to, not to speak to even more faster adoption of decentralized exchanges. And so if you can build a technology good enough, then you're kind of able to build in regulatory comfort within the protocol.
So DC, I mean, you started life in a traditional finance group. I mean, you ran operations for one of the largest mutual fund groups in China, Vocero. You played senior roles on the governance side with Data, yes. Now with the HKDAG group, group, you're now managing institutional money. You've got token funds. How do you see this, the view of the quality of service providers, the role of regulators to actually drive more, drive and bring in more customers? Where do you see that balance?
Okay. Before I go into details, I would like look back like for 20 years at the internet industry. I always see that the regulation always lags behind a little bit before the industry, new trend, new innovation. But finally, at the end of the day, the two sides, the regulator and industry, each has to make some compromise. And somewhere we settle in the middle. This is the big picture I imagine. For institutional investors, crypto is a very new area. From 3 different levels, I see this area is very, very new. First, as all of us mentioned, regulation. Regulation is still very unclear at this stage, either in the U.S. or other parts. In some other places, this new technology or new market doesn't even exist. So, from a regulatory point of view, we still have a long way to go. This is the first level. The second level, from industry players, or as you mentioned about the service providers, for an institutional fund to be considered regulated or compliant, we have to hire some licensed, quote, licensed service providers, namely auditor, fund admin, custodian, if possible. But I was doing this for a while. But when we actually talked to them, the prospects are not so exciting.
The prospects of getting more service providers, or the quality of the service providers?
The prospect of the existing service providers will serve this market. If you go to talk to some auditors, especially those big ones, they would say, I know this is an interesting market, but first you have to give us some time to learn about this market. And secondly, we still see some concerns or some risks. We can keep our dialogue, but we will need some more time to really get into this business. Secondly, you talk to a fund admin, it's the same. You talk to auditors. For the big ones, they can talk with you about the possibility, but if you want them to serve you, to do business with you, the situation may be different. They will not say absolutely yes, but they need more time to figure out how to do this without the regulatory risk. And the third is that if we see crypto as a new asset class, if we do it the traditional finance way, we need financial grade infrastructures, meaning if you're doing trading, you need a financial institutional grade trading system. You have, because the market is very volatile, you have to have your own like a risk control system. You have to do like clearing and settlement and things like this. In this market, we've been looking for potential partners to work with us, but so far we didn't see many. So
DC, if you were to stack rank, what do you think is the biggest gap?
Biggest gap?
Yeah, from a service provider or from a sense of providing comfort and confidence.
I think
what would be the biggest gap?
Would be service providers and regulation. Yeah.
Within the service provider stack, which
custodian?
Custodians.
Yeah, custodian. If if your investor is financial institutions, they want a custodian that has, at the best, a financial license, either be a bank or a trust company. That would be ideal. But now, if you look at the market, not many banks would do that. Not many trust company would do that.
Sobering. Yeah. Sort of moving out from the service provider, the regulator, the infrastructure side, what about sort of the ecosystem? What about just what are some of the more positive developments from a technology perspective that are driving liquidity and driving activity and driving positive momentum? Anybody on the panel, what seem to be some of the key moves on the tech side that are tailwinds for you in these sort of new financial, this new financial space? Yeah. Anybody? Alex?
I will start with identity in distributed world. Actually, we have a lot of problems in this area, and only early stage solutions like self-sovereign identity, and that one is working mostly for persons. And if we will take over people from institutional area and really big money, we will have definite problems where we need to mitigate the risk. Because if you own 1 Bitcoin or half of Bitcoin, it doesn't matter how you keep this, even in custodian, even with no fees. But if your company owns 1,000, and if you have investors who will fight you out, then it is completely another. And another problem of holding private keys is that not company holds these private keys, but exact employee of company or exact equipment of company.
Right.
Not company itself.
Right, it's not a monolith, yeah.
Yeah. And another bad thing is about interfacing between ledgers. On Hyperledger meetings, we continuously repeat the same. Between distributed ledgers, even in permissioned world, and even worse in permissionless, it is almost impossible to transact. It is almost impossible to guarantee settlements between two different natures of distributed ledgers. And it cannot be passed through compliance officer of institutional one, because you cannot guarantee delivery versus delivery of tokens or delivery versus payments. And there is a lot of stuff also on early stage, like interledger protocol, like two-way pegs, like atomic swaps in this area.
That's great. Jack, DC, areas on the tech side that you think, on the technology side, on the that you think are sort of moving the market along, driving more liquidity, driving more participants? What are some of the exciting things that you guys are seeing and looking ahead? Or what might be holding you back, or is there a massive gap or a vulnerability?
Yeah, the technology is still advancing at a very rapid rate. You see so many experimentation on the lower level protocols about scalability. Ethereum obviously has its own scaling path. We'll see whether that works or not. Certainly a lot of effort being put there. And then there's new projects coming out on the way, right? The EOS, Liquidity, these kind of projects. And that's like the power. So things that don't seem like they can be solved, any human being might be solving it right now. And that's why this space is so hopeful and optimistic. And then just going back to this, what came to mind when you're talking about the custody problem is, yes, a licensed custody solution provider might come up with a custody solution for Bitcoin. But then the market needs a custody solution for ETH. Now it needs a custody solution for how do you handle airdrops, how do you handle forks. And so that licensing, while it gives some kind of assurance, it may just not offer that company, unless it's a very technology solution, might not be able to offer the real user what they're looking for. And it reminds me of when in 2014, when Bitcoin kind of went down from 1,000 to 200, people were talking about, oh, the reason this is happening is there are no insurance providers for Bitcoin. Like, what happens if I lose my Bitcoin? And you have two approaches to that, right? You have either multi-sig type of technology approach, which is now more popular. And at the time, you had like, okay, maybe like AIG will offer, or AIA, whatever it is, will offer insurance up to $25,000 or something like that. Because they still think about it in the framework of the FDIC offers insurance, so how about someone offer me insurance on Bitcoin? And that's great, but then what happens when the user now today wants to buy 1,000 different assets? So do those providers offer insurance now on all those assets in real time? And they probably don't, because it's very hard to operate that way. So it's funny that it used to be that you would want your money to be managed by institutions because they have the scale of market access. They have potentially accounts that can buy equities in Bolivia, in Brazil, everywhere, so that you as a retail investor don't have that, so you want your money to be managed by institutions. Now today, you look at institutions, they participate in a very limited set of the asset class. And so you're going to have to think about how the retail has actually a bigger access, than the institutions. So that's going to be an interesting dynamic to play out.
I think the broad, in many ways, the broad theme in many ways is sort of human ingenuity that's at play here. Is hard for, at the pace at which we're moving, it's hard for what is sort of our traditional view of providers, whether those providers provide confidence from a regulatory standpoint, whether those providers provide services from a traditional standpoint, are just going to have a hard time keeping up. And we've got to have a sort of a very different paradigm to thinking about controls, services, information, and communication.
That's right.
It's exciting and it's sobering at the same time, but lots more opportunities. DC, anything coming to mind as we sort of wrap up our time here around things that you're optimistic about as you look out into the horizon, as you look at bringing more institutional money into the mix or getting them more and more confident to participate in this financial space?
Yeah, I just one last thing. Recently in mainland China and in Hong Kong, we've seen some projects that are doing projects for institutional trading, clearing and settlement based on blockchain technology. Actually, they are doing a protocol specifically for crypto trading and clearing and settlement, things like this.
Exciting stuff. Good. Well, thanks for spending time with us today. Thanks, Jack. Thanks, DC. Thanks, Alex. Truly global panel. Thank you for sharing your perspective and your candidness. I'll hand it back to you. Thank you, guys.
Thank you.
Thank you for